Besant running the treasuries, an ex-hedge fund manager. He understands this game very well. So I think on a forward-looking basis, it looks great. But what you've got is this liquidity air pocket that means that there's not as much money around. So the people's propensity to take money off the table is higher. People are nervous. I mean, we've seen the fear index in equities be down at like 8, which is insane considering the market's barely off the highs. So it shows you there's some pervasive sense of fear. And so any movement in the market kind of gets exaggerated very quickly. And I think, after the NVIDIA earnings, people just want to quickly take money off the table. And as you say, next week's a US holiday week. Things start calming down as well. And if you've had a decent year, you do want to protect it. But normally, end of the year is usually pretty strong. And considering they've got to drain somewhat of the TGA to pay for all of the employees they furloughed, et cetera, there's a reasonable amount of liquidity that will come into the economy over year end.
Yeah. Before we jump into 2026, I want to get your read on crypto.
The crypto market is one of our best wealth building options. Digital assets combine exponential technology, network effects, institutional adoption, and global liquidity cycles like no other asset type. That opportunity carries danger for retail traders and even the world's top macro strategists. Nobody knows that duality better than Raoul Pal. He created a complete structure for traversing this region. Even then, he'll confess crypto has humbled him multiple times. One of those occasions was when he started smoking chicken fish, a memecoin he liked, believed in, and lost all his money on. No metaphors, just a straightforward warning that even smart crypto investors make mistakes. Not recklessly, but because the risk curve is harsh. Raoul always returns to his don't mess up rules. Avoid leverage. Avoid FOMO, proper size placement. Invest 90% in network valued assets. Consider every meme play entertainment money. These restrictions matter more than his conviction, as shown by his chicken fish loss. Raoul's story isn't embarrassing. Clarity matters, because his mistake mirrors the market. Liquidity has tightened, sentiment has cracked, and the most speculative corners, altcoins and memes, have been destroyed before a bull market. A true cycle rally hasn't occurred yet. Instead, we've witnessed euphoria, followed by violent air pockets caused by macro forces most investors don't see. We explained that in today's video. Raoul's insights explain the market's behavior. What's suppressing risk assets, and what must change for altcoins and memes to succeed? Please like, subscribe, and comment before watching the clips.
Has been very subdued for this entire cycle, and that's been driven by the high rates environment and the liquidity environment. If you, on a forward-looking basis, understanding all of the fiscal stimulus that's coming, plus liquidity stimulus that's coming, and the probability of rate cuts coming, the chances are the business cycle is going to be a lot stronger going into the election year. Don't forget, we've got Scott Besant running the treasuries, an ex-hedge fund manager. He understands this game very well. So I think on a forward-looking basis, it looks great. But what you've got is this liquidity air pocket that means that there's not as much money around. So the people's propensity to take money off the table is higher. People are nervous. I mean, we've seen the fear index in equities be down at like 8, which is insane considering the market's barely off the highs. So it shows you there's some pervasive sense of fear. And so any movement in the market kind of gets exaggerated very quickly. And I think, after the NVIDIA earnings, people just want to quickly take money off the table. And as you say, next week's a US holiday week. Things start calming down as well. And if you've had a decent year, you do want to protect it. But normally, end of the year is usually pretty strong. And considering they've got to drain somewhat of the TGA to pay for all of the employees they furloughed, et cetera, there's a reasonable amount of liquidity that will come into the economy over year end.
Yeah. Before we jump into 2026, I want to get your read on crypto. You talk about it being a pretty directly correlated to flows. Bitcoin has erased gains for the year. The stock market's still up. What's going on there? I mean, do you worry about, that is crypto just reacting before and ahead of the stock market, or is there something more kind of specific to the asset class?
No, I mean, crypto, there's two different levels. One is, go back to its liquidity. So liquidity has hit crypto more than anything else. and that is the Fed net liquidity that has shrunk. So it's hit that, but then we've got OG profit taking we've seen, so that continues, and that kind of makes sense. And you've got this pervasive opinion that the 4-year cycle is what it is, and therefore you must sell in November and go, October, November, and go away and come back in 12 months time. So there's that pervasive feeling. And then there's, I think, somewhere there is some damage that was done during the October the 10th flash crash in crypto. Now, I don't know if there's a body there, but my guess is the balance sheets of some of the market makers are impaired. So it means that they can't provide as much liquidity as they have done, which exaggerates price moves. I think that probably makes sense. We're also seeing some unwinding of the token holdings by the DATs because of the construct that they've got. They buy back their equity. So, that's ugly, and that will probably continue if price action continues like this. So you've got this supply going on, less liquidity around because of the Federal Reserve and the Treasury, and less liquidity in markets because of impairment after October 10th. Makes it just feel not great.
Yeah. Do you feel like you're getting paid enough to go far out in the risk spectrum? Crypto is at the farthest end of the risk spectrum. It's been tough in crypto, even though, if you weren't in Bitcoin or a select few names like Hyperliquid, you would have really been down for the year, right? I mean, some of these alts haven't even recovered at all-time high. You talk about traditional hedge fund managers, kind of catching up to the Max 7. How do you think about that into, just being in crypto? Is it just only Bitcoin? Is there a room in a portfolio for alt and something else, or is it just not the right time to be going out and far in the risk spectrum?
So for me, it depends on your time horizon. I mean, I don't look at it in year-to-year gains. You look at it full cycle gains. Full cycle for me is the business cycle. So it's not necessarily the 4-year Bitcoin cycle. So you look at the gains over the cycle, and over time they compound. So here we've had a year which has been pretty lackluster. It's gone nowhere at Bitcoin level. But at Bitcoin level means that everything below that has underperformed. And I get it. It feels terrible. I've been lucky enough most of the way through. I mean, I haven't been in Bitcoin all cycle. I've managed to outperform it via just having the right asset allocation. Bought Solana at the lows and then switched into Sui when it had its run. And it's given a bit back. But generally, that's worked fine. I'm not a big fan of going too far out the risk curve. I have this whole don't fuck this up thesis. And a lot of it is every time you think you're really being smart out the risk curve, your probability of success is pretty small. So I tend to stick with layer ones generally because it's definable. I understand the metrics, I understand what drives them. And then, if I look at my wallet of shame from when I've allowed myself to FOMO in on stuff, I allow myself up to 10% of my portfolio to do that. I probably never even get to 10% because it's just not my comfort zone. If I look at it, every single trade I did lost money.
What's been your worst trade?
I think I've lost near 100% in smoking chicken fish, which was like one of the memes that I held, and I had a reasonable sized position in it. And I thought, I can't get out of it because it's just going to nuke the market anyway. So I wrote it up, wrote it down. But, I treat it like a call option. I knew it was the highest probability chance it was going to be a zero. But, you also don't really understand markets until you participate in the elements of it. Yes. You need to get a feel for what it's about to understand what memes are about, how DeFi works, that kind of stuff. So to have a bit of capital that you're going to nuke to learn is a very good thing to do.
Yeah, education as an investor, it's a good way to. I've certainly made my fair share. Talking a little bit about L1.
I mean, the real key thing, and I tell everybody to do this, is like that should only be 10% or less. Then it doesn't matter, and just leave the rest to do its thing.
Right. Yeah, I certainly agree with that. Talking a little bit about L1s, look, that thesis, that trade has been very well since the inception of crypto, like the infrastructure layer. If you were early in Solana, early in Ethereum, early in Sui, say pretty much any reasonably valued, and I say that with air marks just because you talk about metrics. I would be curious to understand, I put out a blog post over the weekend talking about like, how do we value these things? And of course, the bear market sharpens the mind, right? And so I'm curious, how do you think about investing in a layer one, even like Ethereum at 400 billion? It's only cranking out 1 to 2 billion of of fees.
One thing is painfully evident from Raoul's meltdown. We're observing non-random volatility. This is structural. The government shutdown, Treasury General Account accumulation, depleted reverse repos, and quantitative tightening have produced a liquidity vacuum across the market. Simply said, money hasn't been entering the system as usual. When liquidity tightens, riskiest assets, like crypto, suffer first. This is what most investors miss. Raoul believes the forward-looking environment is strengthening despite the stress. As election year approaches, fiscal stimulus, liquidity injections, and rate reduction are likely. He notes that fear is exceptionally high even while markets are approaching all-time highs, which exaggerates little swings and causes unnecessary panic selling. The story is significantly more complicated in crypto. Liquidity crushed price activity. Yes, OGs profited. Yes, the October flash crash likely weakened market maker financial sheets and order books. However, long-term adoption's structural drivers haven't changed. Most retail traders concentrate about the 4-year halving cycle. But Raoul insists the actual indicator is the business cycle. That raises the fundamental issue. Should investors expect dramatic drawdowns if liquidity is the dominating macro force and the next major liquidity cycle bottoms later? Next, Raoul addresses that.
200 to 400 times revenue seems widely overpriced. Certainly not a value buy in my mind. There's people that are calling, Ethereum is going to go to trillions. I don't really see it. How do you think about that input, like that L1, L2 trade that you talk about?
So I think using discounted cash flow models on crypto misses the whole point of what they are, and I think it's a fool's errand to do so. These things are priced off Metcalfe's law, same as Amazon was, same as Google, same as Tesla, same as Meta. They all traded at massive valuations in early stages because it's not about the cash flow. It's about the growth of the network itself, the value that the network absorbs. So how do you value at the simplest level? How do you value a network? It's the number of active users and the total value transacted per user. So that's the way you can normalize every network down to that. And when you do so, it actually makes sense of all the valuations of the chains. It's actually really interesting. There's a few outliers within it. Things like Cardano will be an outlier because there's very little economic activity on the chain, but there's quite a lot of holders, but they're not super active. But generally speaking, sort the networks by that, it works perfectly. So once you understand that, you know what grows the network. It's adding actual real active users that are persistent over time and the amount of economic activity. So if you think of a system like Ethereum, you also count the layer twos because the layer twos are activity built on the same network. And so once you start looking at this, you understand Ethereum's value. So the question is with Ethereum is, will more value be transacted on Ethereum in 3 years' time, 2 years' time? Probability is yes, because of the financial system, stable coins, and all of the things we're seeing. Are there going to be more active users? Not sure, because it's not necessarily retail based. And so therefore, you can still have the same number of active users, but massively increase the amount of value transacted on the network. So yeah, I think Ethereum over time probably does grow significantly in value.
On that point, A16Z put out a great report, talks about the active users on chain. That number hasn't really grown as much because we're sitting at 40 million active users on chain across all networks. The vast majority are in the Ethereum broader ecosystem. On that point, casino churn, it's almost like we're valuing these networks as if they were enterprise recurring revenues, but they're really not. The casino is very cyclical. And so again, I hear you. Just to put some measure to that, OpenAI likely IPOs at $1 trillion. It has 800 million users that are far more stickier.
The only economic value transacted on OpenAI right now is subscriptions.
Correct.
That's not a network model yet. They will unleash it, and it will go to obscene valuations when there is economic activity happening on the network.
Maybe to put a finer point in the question, would you rather own OpenAI stock or Ethereum, ETH or SUI or SEI or Solana?
I would rather own currently I would still rather own crypto because the rate of growth of the total value being transacted is increasing significantly over time. And so knowing what we know, which is once the Clarity Act comes, we will see a lot more economic activity coming on chain from the financial system. Okay, that tells you there's a lot more juice to be squeezed out of this orange. While OpenAI, they're going to have to figure out a business model that works outside of just subscriptions if they want to be valued like a network. The reason Google got so rich is because they are truly a Metcalfe network model.
Yeah. As it relates to monopoly, you talk about Google, like unclear. Do you think that these networks, like the network effects, you have to believe that they have value capture in terms of attention of your Facebook, and the incremental user adds value. The L1, L2 value leakage, so you could argue L2s are going to capture most of the value. It's like...
More excitingly, Bitcoin is back above $90,000, which must surprise critics, but the rapid reverse may not be random. Bitcoin has followed the equity market's risk-on shift in recent days. Restored optimism about big tech, particularly AI-related flows into risk assets, was the biggest trigger. Bitcoin followed the S&P 500, NASDAQ, and Dow higher before Thanksgiving. The Bitcoin to S&P correlation was 0.87 that session, meaning they moved virtually identically. Bitcoin followed stock bids. That association affects retail traders' short-term driving thinking. Bitcoin is currently linked to macro and equities. It moves with them. Thus, equities, catalysts, earnings, AI confidence, and large cap rotation. Markets also expect a Fed rate drop. Typically cited for December, expectations of easier policy trigger liquidity. Lower rates raise risk appetite, lower the opportunity cost of capital, and induce portfolio rebalancing into higher return assets, which can boost stock and crypto flows. The market makes greater sense using Raoul Pal's liquidity theory. Pal has long said liquidity is the most significant macro force in global markets. Risk assets suffer as it tightens. They move at breakneck speed when it expands. The current scenario shows early liquidity turning. Inflows, ETF demand, and equity-led optimism lifted prices off the lows without a major turnaround. It's a subtle change that's typically overlooked until later. Federal Reserve pivot expectations bolster this storyline. If rates fall, or the Fed announces a clear shift toward easing, that may release liquidity and make these modest rebounds stronger. However, Pal's terrible loss on the smoking chickenfish memecoin shows that liquidity doesn't shield foolish positioning. When liquidity runs out, riskiest assets suffer most. When it returns, they may surge faster, but with tremendous volatility and little assurance of durability. His case shows that even experienced macro investors can lose money if they break their own rules. Bitcoin and Ethereum are the safest core assets to invest in, whereas high-risk alts and memes should be considered tiny speculative side bets. Pal's experience proves that the guidelines he teaches, no leverage, no FOMO, no large bets on illiquid assets, are more important than his memecoin optimism. If this research helped you remain ahead of the curve, like this video, subscribe to the channel, and comment below with your market view. Thanks for watching, and keep disciplined.